Hello everyone, my name is Vikas Agrawal. I am the founder of AIF PMS Experts India. So we are a sort of digital platform for investing in alternate investments and portfolio management services. And I'm sure some of you might be familiar that what we do is essentially we invite industry expert and we try and read their mind, understand what's happening in the industry. A and B, we try to understand that what kind of products or investment philosophy they are following at their organization level, and also understand that how investor, especially the HNIs and ultra HNIs or some of the family offices, how can they take maximum advantage of the same offering. So and we we're happy to share that in last 2 years we have done more than 120 knowledge based sessions like this, and I'm glad to share that with me I have Mr. Dinshaw Irani. He doesn't need any kind of introduction. I'm sure you might have started seeing him on CNBC these days and some of the business channels that he appears on off late. He's setting up a great franchise, great manufacturing unit, I would say, which is a natural extension to Helios Capital worldwide in India. And he's instrumental in terms of setting up the sort of framework more precisely as far as Indian market execution is concerned. So, what we do, Dinshaw, is that we organize this session and we say that it's Ask the Expert show. So we invite industry experts like you and we prepare a few questions on behalf of investors because we keep talking to them and we try to clarify all these points. So firstly, thank you so much for accepting our request.
Pleasure's all mine, Vikas, and thank you for a lovely introduction as well.
Yeah. So Dinshaw brings about more than 3 decades of experience. He's been working with Samir ji for over 70 long years, if I am not wrong. Is that correct?
No more. Actually, I've been with him from 2000 onwards, so it's been that kind of a position.
Right. So I think both of you worked in the same organization, Alliance Capital, which eventually taken over by, I think, Sun Life, Birla Sun Life Asset Management Company. So, there's a saying that in the investment world, it's very, very challenging to be with the same team for long period of time. And if anybody is able to do so, I think this can be called as ninth wonder because, you synchronized your thought process with somebody else. And, it's like a Pizza Hut, when you go to Pizza Hut in Delhi or Chennai, if the recipe is same, you have it here or there, it gives you same taste,
Same taste,
So when you have a leader like Samir Bhai, stalwart leader, and then you've been working closely with him, I'm sure there would be a lot of commonality, I would say, in terms of trade, the way you have been so successful in terms of, managing long short fund. We're going to talk about the journey of long short fund. But, I want to take a few minutes out from your busy schedule and talk to you about your personal experience of working with Samir Bhai.
Okay, so actually a great person. In fact, as you rightly said that nobody sticks around for 20 years, 22 years if he's not happy in that marriage, right? It's literally a marriage of convenience, marriage of minds and stuff like that for us, at least. So I worked with Samir throughout his journey in the long side. Actually, I've known him from 94, right? So I used to run this boutique research house with a team of 17 odd analysts. And that's when I started interacting with Samir. This was in Alliance days. And what stood out of that gentleman was his way of thinking, very different from the rest of the managers that we used to deal with. All the other managers were talking about profits, PEs, valuations. He never used to talk about that there. He used to talk about the market, the potential. For instance, I remember Bharti, he said that what is China doing with telecom and where is India today? Right? That was his way of thinking at that point in time. And then he said, so many bikes are being sold every year. I don't remember the figure. He said so many telecoms can be easily sold to these guys who are owning these bikes. And so his way of thinking was very different from what I felt was. So it was always a learning curve with him. And frankly, even today, there are bites which are like pure gems from him. So you really absorb when he gives out these gems as such. So that's what helps. And the best part is he's always smiling. he seldom loses his temper, and that also is very far and infrequent in between. So that's the good part about the gent, I suppose.
So one is like, on the spot, he would say what he wants to say. And at the same time, so they're saying that, I see when you have energy, you don't have wisdom. And they're saying that when you have wisdom, you don't have energy. But Samir is one among those guys, even at this stage, his energy level as well as the wisdom is unmatchable. So many congratulations for you to have been working with him for a long period of time, and I'm sure both of you are learning with from each other and taking the organization to the next level. Now, second question is, there are a lot of investors who have requested me, they want to know more about Helios Capital, how it began. Since you happen to know Samir, so how it moved to Singapore, and what is it that you started out of Singapore, and then we'll talk about your Indian journey.
So actually, Vikas, Samir moved to Singapore in 98. So that time he was in the Lions Capital. And in 98, they made him the head of Asia, emerging Asia. And as a result, he had to move base from Mumbai to Singapore. And since then, he stayed back in Singapore. And then I joined Alliance in 2000, actually end of 99, and 2000 is when I joined Alliance. So I joined him then, and I used to also look at emerging Asia, but mainly two components of emerging Asia, which was consumers and pharmaceuticals. These are the two major components that I used to look after. But report into Samir, since he was managing the whole of emerging Asia. And mind you, he used to manage it with some, I think 5 analysts, if I'm not mistaken, of which 2 were in India, 2 were in Singapore, and 1 was in Hong Kong. These were the breakup of the 5 analysts. And he used to manage the whole of emerging Asia portfolio based on these 5 analysts and the coverages.
This was 1998.
98, he moved to Singapore and he remained there, right? Then we both quit Alliance in August of 2003 and wanted to start a domestic mutual fund. Didn't work out because we realized that it wasn't that exciting at that point in time. And finally, we started looking at an offshore-based fund, right? So Samir stayed behind in Singapore. I was always in Mumbai. So we said what to do. Long-only funds at that point in time were not that exciting because the fee structures, and we would have been just one of the participants in the whole big pot of offerers, manufacturers rather. So we said what to do to be a bit different and how to convince yourself that you can do it. Mind you, we were only long-only managers at that point in time, right? So we came across this data. We used to keep churning data and all, and we realized that India has much more volatility than any other market as such. We saw various reasons. And in fact, in our, the best thing that we put across is we compare US S&P to India Nifty and how the two move. So the best part about volatility is that if you can capture on the downside, if you can conserve on the downside, you can kill any guy on the upside, right? So that's what appealed to us. And that's why we brought about this hedge fund. And we started off with Helios. So we set up Helios in January of 2005. And we said the first offering should be a hedge fund. And a hedge fund will be a long short fund, India dedicated, because our forte was India. And that's how we came about doing this long short in India as such. So we started this long short in January, started deploying money actually in June, July of 2005. And it's done handsomely well. In fact, it's beaten most of the long only guys, not only offshore. By the way, our average net is always been around 62 in the last 17 years that we've been in this long short fund. And with that 62 net, we've beaten most of the long only funds as such. So across, not only in offshore based funds, but also domestic mutual funds. If you convert this thing to rupees and remove the performance fee and only take the asset management fee, we've beaten most of the mutual funds also, domestic mutual funds also.
I was looking at the data, and you will not believe, I said, यार तुम मुझे long short नहीं, मेरे को long only का performance दे दिया लगता है. एक काम कर निरुपम, मुझे आप long short का दिखाओ. बोले long short का है. मैं बोला फिर तुम्हारी कुछ गलती होगी, दोबारा चेक करो. आप मुझे गलत डेटा दिखा रहे हो. long only का दिखा रहे हो. इंडियन का मैं पिछले 20 साल से इंडिया में मैं. Then I looked at it, I said, oh my goodness, what a performance. And I had some idea because I interviewed Samir Arwaji.
Samir also, yeah, I remember that.
Right. Yeah. So now coming, second question is, before we come to the journey of the long short fund in detail. So can you talk to us about how your organization is structured in Singapore, and which are the markets that you cover, which are the funds from there, who is managing, Samir is managing what you, and then talk about your Indian outfit that you are setting up.
So we, out of Singapore, by the way, we raised money. We have feeders across, I mean, US and all. We used to raise money there and deploy it via Singapore. That's how it was. The most major market and the only market we cover out of Singapore is India and nothing else. Our focus and our love has always been India. In fact, Samir, when he used to tell everybody that. He says, though I'm in Singapore, but my heart is in India always. And though I'm managing emerging Asia, right, where India's weight at that point used to be around 7-8%, he says, but 70% of my time goes in India. I don't want to look at other markets. So that way, in fact, I also used to cover quite a few Asian markets and used to pick out only the best stocks in the other Asian countries and play the market like Samsung in Korea and stuff like that. I used to pick up those kind of names and play them. But India, I used to do pure, hardcore, bottom-up research and work that way. So that's what his dedication was. And even today, our money, whatever we raised, is mainly for India, and it's only for India. We also have a global offshore fund, which is X of India, which invests in all of the markets except India. But that is only for friends and family, like employees, friends and family. And that fund is purely, if I may say so, it's bulk of it is US, some portion in Europe, some portion in China. But that's like a fairly close fund as such. It's not for public consumption. It's for that. So bulk of the money is India. So what we did further in 2011, actually 2010, ICICI Prudential had approached us to give them an advisory in one of their PMS offerings, right, which was called Star Alpha India Fund. So we became advisors to that fund in 2010 end and started deploying money in 11. From 11 to 19, we were the sole advisors to that fund, and that fund did phenomenally well, right? And we said, okay, this is something that we can do on our own. Why do we need a ICICI Pru to do it? Because ultimately, they're also going to other distributors to distribute that fund. So we said, why don't we start our own? So we applied for licenses for PMS and AIF both in 19 and got our licenses subsequently in 20. So by March 20, we started our own domestic offering in PMS. That's what we did. We started with that. And then next year, we started the AIF, which was the first offering. There was a long-only AIF that we started. And that's how the journey has been accomplished as such. So
talk about your Indian team. How many analysts, and how's the investment structure? Like, you have CIO, or you continue to head, or how is Samir's intervention in the whole thought process? And we talk about your plan also, like you applied for mutual fund license. So these two things, if you
Sure, Vikas. So basically in India, I'm the CEO, CIO. Obviously, Samir is the mentor for everything, all the funds that we are offering. In fact, every morning we are on a call together and we discuss what to do with our. In fact, that's what he said, that we are lucky we started with a PMS. Though most of the managers don't like running a PMS product because it's a very complicated product. Each client has a separate, has to be holding a separate portfolio and stuff like that. But we said we are lucky if we had a PMS, because by default, every morning you're buying a set of stocks for a client, right? And as a by default again, you have to analyze each stock every morning to say whether this is the right weight for this client who's coming in today. You may have made a lot of money for the first client who came in, right? But suppose you had bought 2% weight and that has become 5% because of the expansion in the value of the stock. Is it worth enough for the new guy coming in? If it is not, then you even trim for the old guy. So that every morning we have that kind of an argument or that kind of a discussion, and then that's how we go about. So mainly it's the three core gentlemen, rather four people who are at the core of this team are Samir, my colleague in Singapore, Alok, who's our head trader, then my head of research who sits here, Abhay, and myself. So the four of us together have roughly around 27, 28 years of experience each per head. So you can imagine that 110 years of experience sitting together and, talking what all things could be coming out as such. So that's the exciting part. Apart from that, we have a core team of some 4 analysts, and obviously we are adding a few more analysts to our team. In fact, we've already given our offers to 2 other analysts, and we're looking at 2 more to join in. and we're developing that core also going forward. And the criteria for our team is that you need a minimum 5-year experience to be a part of the team. Obviously, there'll be some juniors will be developed at a later stage as such. So that's how we're going about it. The operations, actually, the whole team out here today is around 27 odd people. 19 of them sit in Mumbai. 7 are spread across India. They're mainly the sales team as such. But we're also adding quite a few. In fact, I was checking with the admin guys before I came on the call. By Feb, we'll be roughly around, Feb end, we'll be roughly around another 37, 38 odd people. So that's how big the team will be, including the analysts and so on. So that's how it is.
Great. I think those who are joining, especially on the fund management side, I would say that they would be lucky people because एक में 2 मिलेगा उनको पैकेज दिनशा जी के साथ काम करने का मौका और समीर जी के साथ में काम करने का मौका. So I think they want.
Sorry, because what I forgot to add was about the mutual fund. So we already have a in principle license received from SEBI. The parent received the license, which is Helios Singapore, and obviously since the subsidiary in India is Helios Capital India, so we'll be looking at implementing that license in the mutual fund format. But for that, we have to apply to SEBI for the final license, which we're in the process of doing. There are quite a few things that will be filled up before you go and apply for the final license. So I think we're another 5-6 months away before we can actually launch a scheme under the mutual fund as such. So that's where we are on the MF side.
Yeah, I want to read your mind, Dinshaw, is, so now you'll have mutual funds, you have PMS and AIF. And this question is a very common question that I keep getting. Which one you think, which instrument can be utilized more efficiently according to you and deliver the highest returns?
So our belief is it's mainly the AIF product which can be done. See, the PMS is a very good product, but it depends. Actually, our offerings are across the two. So PMS AIF more or less will be the same strategy that we are following in our long short fund. It'll be, and that has been around with us for the last 20 odd years, and that's why it's very close to our heart, and we can implement that. But PMS appeals to a certain set of investors, and that's mainly the guys who can hold the stocks in their own name, right? But AIF is a perfect vehicle for those who don't want their name to be tagged to a particular stock. So it's like akin to a mutual fund but for high HNIs, right? So that's how it is. In AIF, there's enough flexibility for the manager to churn the portfolio, to get a new stocks without even selling an old one, because there'll be some pool of money lying at some point in time and stuff. So that flexibility is there for the manager, which is not there in the PMS. In the mutual fund, it's gonna be, you need to be close to the index, right? Because you're appealing to the retail. You need to be along with the retail. Though we are looking at certain differentiated products, which I won't disclose on the call today because we are still in the process of formulation, and we'll probably surprise the market when we bring it out as such. So that's what we're trying to do here. But still, the manager's hands are tied to the extent of one highly regulated body, so he can't think too much outside the box. Plus, he has to be close to the index also. He has to give you the returns which are slightly better than the index, not too outperform, because you can underperform also to that extent. So in a mutual fund, that won't work. So I believe for a HNI, the best vehicle would be an AIF, then a PMS, and then probably a mutual fund or retail. That's how it should be.
All right. So for our audience, I just want to share that, there's something called long short, which is also called as absolute strategy. This is also called as hedge fund in the global economies. Now, when you look at the global economies, especially the US markets and some of the other developed UK markets, this strategy is very, very successful, and some of them have been running it for over 1.5-2 decades, and these are pretty sizable strategies. But when it comes to India, this was, I think, very new. Like a lot of investors, generally they have the habit of investing in arbitrage fund if they have some money for 6 months or 1 year or 1.5 years. But they've never tested this. So what I feel is a lot of work is going on here, and a lot of work is already been done by Helios. So today's agenda of discussion is to showcase what is called long short fund, for which I have requested Dinshaw ji to share his thoughts on, and then talk about the journey of long short fund at Helios. So over to you, sir.
Thank you. So because basically, let's understand one thing. There are two sets of long-short funds. One are called pure absolute return funds. There are actually three types, actually, if you will. One are pure absolute return funds, which are more or less market neutral. So they'll have probably 90 long, 90 short, and as a result, it's like more or less zero, very close to the index is what they will. Not even close to the. Sorry, they will give you
not
certain
even
absolute returns even in a down market or in an up market. They'll give you margin. They will not be able to capture the upside, but they will not even fall on the downside. So basically, they'll be more or less somewhere there, right?
Yeah, so it's basically a replacement of fixed deposits in India.
Not even that. It's probably debt minus to that extent, because in India the debt levels are much higher. The debt levels are much
minus.
So right. It's more of a US based product where the debt at that point in time used to be around 0.25 and 0.5, and so it was for those guys who wanted to diversify beyond debt, that kind of a product. So which is not valid for India. That's our gut feel, right? So that absolute return product is not what is meant for India, because India, the market is also volatile. Your debt is also giving higher returns. So that way. The second set was more of a debt plus kind of a product. Now that product was mainly a 20% net or 25% net. I mean, there'll be probably 100 long, 80 short, or even 60 long, 40 short, and the rest money in debt and stuff like that, right? So that was the way the product was formulated. In our case,
leverage, the second category, non-leverage, like it will have only 100 to 100 investment, right?
Yes, non-leverage, totally non-leverage, because their shorting will be more or less probably an index short or keeping cash as a short, as a hedge. So that would be the case here. But in our case, when we started, we said we have to be different, right? That's what I told you, that we did a lot of data crunching, and we realized that the best way to play India is to have a equity plus product with a lesser net. So basically, you cut out the volatility from the movement. And as a result, let me give you a mathematical example just to make you understand. Suppose the market corrects 20%, right? One guy who's like totally 100% invested to the market, he falls to 100, becomes 80. What if we just 0.9, I mean, on a beta front? So you'll from 400 to 0.9. So ultimately, what is the logic of hedging, right? You cut down the beta of your portfolio by putting in a negative hedge, by actually shorting a stock, right? So so the other fellow falls to 0.90, yeah, because he is 0.9 beta or whatever. For the 80 to rally back to 100, he needs a 25% rally. 90 fellow needs just an 11% rally, right? So you cutting the guy off purely on just conserving on the downside. That's what we believed it was the case in India, and that's why we played it this way. We said we'll work it this way, that we'll be a debt plus, and as a result, that's what we've done. We've given handsome returns, which have beaten most of the long-only offshore funds and also the domestic mutual funds. And I'll again share I'll just give you one slide to share, if you allow me. I'll ask you a trick question, by the way, even before. Let me put on the slide and then ask you the trick question.
Yeah, please.
This is a regular presentation, but let me straight away take you to the trick question. Yeah. So here's the question. If you know that the market is going to go up by 100% in 2 months, right? Would you prefer to buy a long-only fund or a long-short fund with a 60% net exposure, right? Obviously, the obvious answer, since today I'm selling a long-short fund, so you may think that why am I even talking about this? Fact is that you will say it will be a long-only where 100% is guaranteed.
Right.
Actually, the right answer is it depends. Since I told you about the volatility bit, now let me share that with you. Let me actually share that with you.
Sure.
Now, this is a pure long-only fund with 100% exposure to equity, right? So the market moves, say, in the first month by 900%. So the 100 rupee will become 1,000 rupees, right? That's how it will be. But the next month, the market corrects 80%. So your 1,000 rupees becomes 2,000 rupees in the next month, right? 200 rupees.
200, yeah.
200 rupees, yeah, in the next month. So as a result, your 100 became 200 in the 2 months, but actually you lost from 1,000 to 200, but still it became 200, right? Now let's look at a fund which was just 60% exposed. This is the beauty of volatility. Now suppose the first month, the market was up 900%, but you could only capture 60% because you were 60% exporters, right? So you will capture only 540% return as compared to 900% return. So your 100 NAV will become 640 NAV. But when the market corrected 80%, you will again capture only 60% of the downside, which is 48%. So your 640 will become 332, or rather 333 if you want to round it off as such. So you're better off in a long short fund than in pure long only fund. This is what volatility is all about, right? So then I told you we did a lot of data crunching. Yeah. So let me tell you this is the same thing. What the data crunching we did was this. So when we started off, we took the historic data actually, but today, since we have the live data in front of us, I can share that with you.
Sure.
From June of 2005 till today, which is, I think, November end is what we looked at. There are 208 months of returns that have been captured in this 17 odd years, right? Now, a period return is normally what? P1 into P2 into P3 into P4, where the period is represented by P and the month is by 1. You can multiply the months altogether in a sequence. But since it's a multiplication, it does not matter. The sequence does not matter. So you can multiply P1 by P100, P100 by P7, P7 by 120 and stuff like that, and still get the same return, right? That's how it is. It's a multiplication, so it doesn't matter. So what we did was, we said, okay, let's try and bake up this monthly returns into positive months and negative months. Put both the buckets aside and then multiply these buckets together to arrive at a return. So, for instance, in the case of a US, the S&P 500 had 141 positive months and there's 208 odd months, right? The cumulative return which they generated in this positive return months was 7,837%. So basically, your 1 rupee in a positive, only in the positive months, became 79 rupees, right? 7,800%. Okay. But look at what happened in the negative months. They had 67 negative months in which they lost 94% of the returns that they generated in the positive months. And as a result, they were left with only 368% in the period return, right? So 94% into 7,837% would roughly give you 368 odd percent, right? That's how it is. So basically, you lost so much and you were left with roughly around 5 rupees. I mean, rather from 79 rupees, it came to 4.5 rupees to be more precise, right? So that was on US. But now, on the same time period, look at the data that comes out of India. It's mind-blowing because you can't even guess the numbers that we are dealing with out here, okay? That's why I say India volatile market, perfect for long-short funds. Okay, here it is. So the orange line is basically the volatility that you saw in the US. Look at the dark line, which is India's Nifty, okay? S&P 500, India's Nifty only, yeah, sorry. So look at the number. The Indian market had 126 positive months in this time period. The return in the 126 months was 43,245%. So basically, a 1 rupee invested at the time of the beginning of this run would have yielded you 434 rupees straight away, right? That's the kind of positive returns you made in the positive.
432 times, right?
Yeah, 433 times actually, because it's 30%, right? 43,245%. So you'll have to add 1 if you took in the number of times. So it becomes 433 times. 433.5 times is the return that the market made in the positive months.
From which year to which year, sir? This one?
This is from July of 2005 till November of 2022.
Almost 17 years.
Yeah, almost 17, over 17 years, rather, more than 17 years. But right. That's all. So 208 months. Look at that way, right? So we're saying that 126 positive months yielded a return of so much. Look at the negative months. There were 82 negative months, more higher. Again, the number of positive months were lower than the US, but the returns were like almost 6x of the US, okay? The negative months were less than the US. More than the US. But look at the returns. I mean, look at the negative returns. You lost 97.6% of what you made in the positive months. And as a result, you were left with a total return of 938%. So now look at these numbers in a more roundabout fashion. Okay, let's not look at 433. Let's assume that the market that you made 400 times in the positive months, right? You lost 98% of the 400 times. So you were left at the end of the period with 8x return, right? 400 and 2% of 400 is 8, right? That is what you were left with, 98%, right? So it goes out of 100, so 2% is left. So you were left with 8x. Now suppose a hedge fund like me, he just loses, say, not 98, but 97%, right? I just conserve 1% beyond the market. We've done much more, by the way, out here. But suppose I just conserve 1%. That means my return becomes 12x as compared to 8x for the long only guy. For him to beat me, in the positive months, he'll have to move up by almost 600 times as compared to 400 times. Just to beat my 1% conservation.
Yeah, so this is turning out to be an equity plus then.
Equity plus, exactly. That is what. So let me show you the data of our fund. I mean, this is getting more interesting. Okay, so this is what I told you about S&P, basically the whole return and Nifty return and stuff like that. What I explained to you, right? This is how it goes. Now, this is what our fund returns are. Okay, the Helios Strategic Fund, which is actually a long short fund, we've tried to show you the return over time periods, different time periods. So let's look at the first time period, because normally people say that 2008 आपका अच्छा होगा क्योंकि बाजार इतना गिरा था तो आपने अच्छा कमा लिया होगा उसमें. So that is what the thing is, right? So now let me show you here. From July 5 to December 31st, 2008, right? The positive returns of the index was 411 months. 411%, right? Look at our returns in the positive months. We were only 342%. So we lost out because we were net 60, right? So that's why we lost out that return. In the negative months, the market lost 73%, 74% to be more precise, 73.7 in the negative months. We lost only 68%. We conserved 6% as compared to the market. And look at our return. As compared to the Nifty return of 34%, 35%, we were at 41%. We beat the Nifty, okay? Come to the next month. Come to the next period, which is July 1, 2009, Jan 1, sorry, 2009 to November 22, which is the month gone by. In the positive months, the market gave a return of 8,378%. We again underperformed on the long side. I mean, on the positive side, we were only a 5,800% return because we were 60% net. But look on the negative months. The market lost 90.9%. We lost just 8.5%. Conserved 10% of the downside. And look at our return. As compared to the index return of 670%, we were up 160%. 1,060%. Sorry, 1,060%. That's how the returns are. Look at the overall returns. This is what the fun part is. I shared this with you, right? 43,000% return roughly of the index. We just captured 26,000% of that 43,000% because of the 60% net. But on the negative months, the markets were down 97.6%. We lost just 93.8%. And look at our return. We 2x, literally 2x that of the index.
So I have a question here. Sorry to interrupt. So this was like, why 60-40? What was the logic behind the component in underlying is 60% long and 40% long short?
Right. So basically, the whole idea of the 60-40, actually there was no this thing. We learned it along the way. Till around, say, 2007 end or something, or probably beginning of 2008, we roughly were some 80-odd% net kind of a fund. I mean, rather 100 long, 25 short and stuff like that. That's how we used to be, okay? But then came 2008, and that 2008 taught us a lot of lessons. Because till then, we used to think that shorting an index was a hedge. Or for that matter, buying a put is a hedge. Or having cash in your portfolio is a hedge. That's what our belief was, right? Everything went out of the window in 2008. We realized that markets can crap out so big that even the index can't protect you. You need to have components within to short, which can give you that additional alpha over and above the index, even on the negative side, right? So that's why we said that from now on, puts are out of the window. Puts is no more a option for us, because puts we realized were more of a black swan event. Otherwise, you just end up losing your premium rather than anything else.
Yeah, month on month you
just
lose.
Give you a notional. It just gives you a notional hedge and nothing else beyond that.
Yeah.
So we said actual stock shorts is what we should be having. So today, if you look at our portfolio, we have anything between 20 to 25 stocks which are short at any given point in time in our portfolio. And these are actual names, X, Y, Z, and stuff like that. In fact, you get a lot of options, by the way, in the market to short. The only thing is that you should have that expertise. And we believe we've developed this over 17 years and we are quite home and dry.
Amazing.
Yeah, so that's what it is. So actual stock shorts, you can use the index, but only temporarily. So suppose you look at if you feel the market is going to be falling off the cliff, suppose something like today, Japan increased the hedges and you felt that probably markets are going to crap out in a big way and stuff like that, which we didn't do. But just to cover your position at that point in time, probably you can short the index, but over a period of time, substitute it with stocks. So you keep replacing. Suppose you shorted 5% of the index, but then you added X name of 1% to reduce that to 4, then another 1% reduce that to 3. So you use that as an immediate hedge, but then replace it at some point in time. So that's what we do, and that's why we are probably so successful in our long short fund per se. So
I just want to highlight here that those who are there listening to us, well, the number looks very easy to understand, but to run this, you require a different mindset altogether.
Totally.
To see that your long only is losing year on year for 5-6 long years, and then in order to protect the downside, you require a different thought process altogether. And I am not able to even visualize when you are speaking with us, Dinshaw, that what sort of patience requires, when you see intentionally you want to lose out on the long side, because you're not going beyond 60, and from 80 you're going down to 60.
So Vikas, actually we keep shifting the hedging. I mean, it's not that we are purely married to that 60. That 60 is an average of the year. Okay, at certain point in time, in fact, at the time of demon, we were the lowest. I think we were at some net 5% or something. So that's how low we had gone in demon as such. In fact, even during the present year, when the war broke out, I think we were at some 25, 26% or so in the net basis. So that's how we keep playing around with our net as such. And that's why that average is 60. So sometimes you'll see 80. In fact, at the time of when Mr. Modi was announced as the candidate for the prime ministership, which was September of 13, we were at a massive gross as such, because we were like almost close to 100% on net basis, but we still had a short book running with us. So that's how we keep playing this as such. So there you can leverage, right? So we are at that point, I think we were 130 long and some 50 shorts on net 80 and stuff like that. That's how it was. So that's how aggressive we can be on both sides of the book. And that needs to be done on a real-time basis. You can't just sit and say, okay, meri book itni hai, I'll just sit there and I'll just see how it works out. It doesn't work that way. So that's how the aggression comes in. And by the way, one more thing that I would like to highlight here is we are not technical believers. We do not believe in quants per se. We don't have a quant analyst with us, but still we short. And that shorting is mainly fundamental driven. It's pure fundamental shorting. We do not short on valuations. We don't think that valuations can be out of whack for a very long time, and that can take away a lot of money, right? But we do short on valuations only when we see an event building up. For instance, like some of the paint companies that we shorted earlier was mainly they were anyway stretched on valuations, 70, 80 times forward earnings. But then the crude oil started bloating up, and we realized that it's a matter of time before the consumer ultimately pushes back on the price hikes and stuff like that. And that's what happened, right? So we shorted and margins came off and the stocks came off and stuff like that. So that's how we keep playing around. And there are lots of examples like this, not only paints, even in the diagnostics business, we did that. In pharma business, we did it, which are like pure bread. In fact, today we're doing it in IT because really IT is overpriced. And I think it's a matter of time when before IT starts crapping out. So that's what we keep doing that.
So we have 15 minutes left out and couple of questions quickly. So one is this, there's this perception in the market, Dinshaw, is that, Helios is the DNA or the whole ethos of the organization is more emphasized towards long short, as a thought process. And then initially when you started with the long only thought process in India, we were facing this question from the client that, so can you clarify that when you run, how do you run different machines with different mindsets at an organizational level?
So, okay, Vikas, actually, when we started off Helios Capital, we did a long short product, as you rightly stated. But there are always two legs to a long short, right? There's a long leg and a short leg, right? In our case, the long leg is driven fundamentally, and even the short leg is driven fundamentally. Now, let me just explain briefly of how we go about selecting the stock in the first place. So we have this. First thing is what we realized was that in India, you need to have an anchor to hang on to. Right? You can't just look at the price volatility and take a call on the stock. So we said the best way to select. So ultimately, index, certain set of stocks outperform and certain sets underperform. Right? Set of stocks underperform. Right? That's why the index average is the way it is. What we realized was that the set which outperforms, if you take out the consistent performers, there were specific traits to those, and even the losers also had a specific trait. The trait of the losers was much more easier because we realized that bad is very easy to define, good is not. Right now, for example, I can like the question that I ask most of my clients when I'm doing a pitch to them, and most of them are industrialists, so they can relate to that question. Is that who is a good employee? Tell me, give me an example and give me a statement of a good employee. Most of the time, the answer, by the way, one Japanese guy was a very smart guy and he gave me the right answer. I'll share that also with you.
Okay.
So most of the time, the client gets back to me saying that one who contributes positively to the overall performance of the company. Right? That's a standard answer that I get from most of the clients. So my counter to that is, okay, he sits till 8 o'clock in the night, he slogs himself off, he contributes, but at the same time, he's a regular visitor to a bar, gets drunk in the night, uses woman. What do you say to that, right? He said, "Oh, we'll fire him," right? So bad is defined. Good cannot be defined, right? So when we look, so by the way, I was telling you about the Japanese guy. So the Japanese guy gave me a very straightforward. He says in Japan, we say that an employee is good if he doesn't have anything bad. This is what he said.
Wow.
And he agreed with me. He said, yeah, bad you can define, you can't define good. So that's how his argument was. So he got the right answer. So in bad, if you look at the way the market classifies bad is mainly they are bad industries, bad themes, bad managements, bad corporate governance, bad fundamentals, right? These are the general bad that you have, bad valuations, or some triggers which are going to be bad for the company and stuff like that. Yeah. So these are the broad bads which are there. So we said, what we'll do is, we will have this set of 8 parameters on which we will classify our stock. So we run, say, a NSE 500 is the starting point. We put it through the siphon of these 8 different sieves, right? And whatever is left behind, we don't know whether that's good, but we know what was rejected was bad. So that is what we play with. The bad that are left behind are the ones which we use for the shorting business. That is where the shorts come out of. And the good is ultimately makes it to the portfolio as such for us to play with. So both legs are driven by fundamentals. The long leg, in fact, when we started our India offering, which was a long only offering, we said we'll take the long leg of our long short fund and just do a mirror image for a long only fund. That's what we did. Right. And now the long short is a pure no-brainer. We take the whole fund and just deploy it. That's how it is.
Right. So how is this fund is registered now? It's SEBI now in India, and how investor can participate?
So in the long short fund, you say?
Yeah.
So it's registered under AIF Cat 3 as such. And how we're going to run it also is very different. So what we're going to have is we're going to have 2 separate funds inside. There'll be one which will be a long only, which will have a 70% portion of long stocks, which will be mainly cash stocks lying in that long only fund. And this will be a stable part of the portfolio. 30% of the money will be in a long short fund, actual long short. So there'll be 40 long and 30 short. So 30 long and 40 shorts. Is that how it will be? So it will be a net negative 10% portfolio.
Can you if you don't mind, because for benefit of myself and for my investors also.
So 70% of the money. So suppose you give me 100 rupees, right? 70 rupees will lie in the long only portfolio, which will be cash. There won't be any F&O in this.
Right.
There won't be any futures in this. Pure cash stocks that we bought in this portfolio. The 30 rupees, what I'll do is I will deploy of that 30 rupees, since I'm going to just pay a margin, by the way, so I'll keep that aside. In that 30 rupees, what I'll have is a 40% short portfolio running. I'll actually short 40% futures in that, basically stock futures, right? And 30% futures I'll buy as long, which will be an extension of my 70. So suppose the HDFC Bank is lying here and I need a weight of 7.5% of HDFC. So 5% I'll have in the cash portfolio, 2.5% in the short portfolio, in the long portfolio. It'll lie as a long. Short will be something else. It won't be, the same stocks will not be shorted.
Right.
So as a result, this will be a net negative 10%. Since you're 40% short and 30% long, it'll have a net negative 10%. 70 minus 10 is what it is. Now here, understand one thing, since my gross exposure is 70, I will just need 14% cash, 20% margin, roughly I'm calculating, right? It'll vary across, but I'm taking the maximum one. 14% cash is what I'll be requiring for playing that for 70% gross book. 16% still will be left with me as cash. That I'll put in a debt fund where I'll earn around 4.5% odd or something and cover that out. So that's how it'll be. So my taxation also will be varying. This book,
I was coming to that. So how is the taxation going to be? Because it is under Cat 3. So Cat 3, all the taxations are done at the instrument level.
Yes, at the fund level, at the trust level, yes. So here, the 70% book will attract only long-term, short-term gains, right? Roughly around 10% is what we're looking at, because this book will not vary too much. There'll be some portion which will come off, but more or less it'll be a 10% kind of a tax book with the long-term capital gains. Here it'll be your marginal tax rate, which for the fund will be around 43%. But here, since you're running a negative 10, we don't expect that much of money to be made out here. It's only for hedging on the downside, right? So you're conserving on the downside, so that way. So even if you take a blended, and suppose we make money out here, we're lucky enough, we're looking at a blended tax rate of roughly around 19 odd percent, 18, 19% is what we're looking at in this.
This is on a conservative side. Let's say even if it is 20%, at a gross level, so 20% is what client should look at. And so whatever is the returns minus 20% is all deducted at the fund level, and then whatever money
is given out, yes,
in the hand of investors, it comes there. Okay, all right. My last question. So we had a lost out decade, from 2010 to 20, and obviously when we looked at your US graph and Indian graph, we realized that Indian markets are more volatile. As we embark the journey towards $5 trillion, $7 trillion economy, moving from inflection point towards becoming more developing nation, obviously, do you feel that the volatility will continue the same way, or it might reduce, or do you think this number that we saw is doable?
So basically, the volatility is a part of the game altogether, right? That's what equity markets are all about. But our belief is that with the market becoming more and more vibrant, because you're talking about a market becoming bigger, our belief is the volatility, because it's a class of consumers, right? Look at the kind of investors that are there. We're just growing big, right? 10 crore is the demat accounts which are now operational, which was pre-COVID, I think around 2.5 odd crores. So you're seeing so much of flows coming in. So at least for the next 4 or 5 years, I think the volatility will remain. You rightly pointed out that the economy will grow faster. Actually, that is our belief, that India in the next 10 years will be one of the fastest growing economies. It looks like a no-brainer today because our belief is so strong. But we believe that next 6 months will be the trying months. So that's when you need to conserve here. And in fact, even if you're looking at a long-only product, we are talking about people staggering it out as such and playing it. So our belief is the same, that volatility will continue in the markets because our F&O market is very vibrant. And that's what really helps in the helping the volatility per se. So that's how it will be going forward.
Sure. I would request all the participants, if you have any question, please type in your question in Q&A box. The first question which has already come in from Mr. Sharma and Vivek Sharma. Yeah. So the question is, how is the redemption played out? I mean, how the transaction takes place?
Sorry, what is that?
So
Redemption?
in the sense that there are few long shots, they give you redemption at the end of the month. Some ask for 1 month.
Okay, so we are a monthly closing fund. I mean, it's like an open-ended fund only for us. But I think the first month is a hard lock where you don't have any redemption. The next 3 months you can redeem with a marginal, I think, fee of 1% as a exit load. And after that, you're open to move out whenever you want to move out. So there's it's 4 months basically.
Do you require a notice of 1 month, or it is done within T plus 5 days? How?
No, you need a notice of 1 month. So every closure you will be allowed to give out that notice. So as I said that after 1 month of hard lock-in, you can move out anytime. For 3 months, first 3 months will be exit load of 1%. But beyond that, there's no exit load. After that, you can move whenever you want to move. So
right.
That's how it is.
Second question, is there an entry load? See, as far as entry load is concerned, it is not there. These are long short funds and it does not even justify that. That's
right. No,
cost. So it has to be a win-win situation for everyone,
yes,
for the manufacturer, for the advisor, and for the investor. That's how it can complete. So obviously, you will not have that time. What is the expense ratio?
So expense ratio is very marginal. I think it is less than around 20 paisa. Though we provided for 25 paisa, but I think it's less than 20 paisa or so. I think my sales guy would be the right guy to answer all that questions.
Right.
He'll be the.
So what we'll do is, we'll take these questions offline, and I will speak to you, Mr. Sharma.
It will be less than 20 paisa. That's what I feel. Yes.
Right. Okay, there are no more questions. So, all right, thank you. So with that, we would like to conclude the session here. It was great talking to you, Dinshaw. Many congratulations for a successful beginning in India. Now Helios is very much familiar amongst investor community, especially family offices and HNIs, and your presence is only adding up a lot of value to our investors, especially your appearance in a couple of business channels of late. At least I follow that. So thank you so much. And once again, thank you for accepting our request and look forward to have you again. You appreciate that you are taking the time out from your busy schedule and talking to our investor, putting efforts to educate them and empower them. And we keep doing that.
Thank you. Thank you, Vikas, for having me on the show. And thank you to all the investors for taking the time out to be on the show as well. Thank you.
Thanks. Yeah. Bye.